Hello everyone. Today's video is about finding the perfect entry point based on the confluence of 3 timeframes. This video follows up on the previous video. Top Trader reveals best price action techniques for 2025. If you haven't watched that video yet, please watch it first before coming back to this one, because in this video, I won't repeat the concepts that were already explained in detail in that video. Instead, I'll build on the knowledge I've already shared with you. More importantly, this video includes my experience, which I believe is the most valuable part. Knowledge can be found in many places, and there are many other channels that have made videos on entering trades based on the confluence of 3 timeframes. Knowledge can be copied and adapted, but market experience cannot be replicated. That's what makes it valuable, and I haven't seen anyone share this for free online. Now, let's dive in and look at the charts to find the perfect entry point based on the confluence of 3 timeframes. The 3 timeframes I use are 4 hour, 1 hour, and 15 minute. I start with the highest timeframe first, which is the 4 hour chart, to identify the market's trend. On the 4 hour timeframe, I only focus on the price zone closest to the current price. That's this price zone. I don't care about what happened before it. In this price zone, the trend is currently bearish. It's bearish because the price has formed a lower high compared to the previous high, and a lower low compared to the previous low. Therefore, I'll only look for sell trades in this scenario. Next, we move to the 1 hour time frame to analyze price action. This is a corrective trend, a bullish pullback. The price has formed a key level here. If this pullback trend continues, there are 2 possible scenarios. First, the price continues to rise and breaks above this high. Second, the price retraces to this key level, retests it, and then continues upward. But no. The price has broken below this key level. Plus, the current market structure is bearish. It's bearish because the price has formed a lower high than the previous high and a lower low than the previous low. Therefore, we confirm that this pullback trend has ended. This is the moment to observe for a trade entry, because the pullback has ended. We move on to the 15-minute time frame. In this bearish trend, if the price retraces to retest, it typically retraces to one of 2 places. First, this low, which is this key level. Second, this significant key level. When the price retraces to this key level, a reversal candlestick pattern appears. If I recall correctly, this is an evening star pattern. So, we would enter a sell trade in this case. No, we don't sell right away in this case. Remember, when you see a reversal candlestick pattern at a key level, don't rush to enter a trade. Why? Because, recall my trading mantra. The current minor wave is a bullish wave. We don't sell in a bullish wave. Let's observe closely here. At this price zone, a key level appears, because the price was rejected. At this price zone, there are a total of 6 candles that were rejected here. The candle wicks reacted to this price zone. So, this is indeed a key level. When the price retraces here, it might bounce up. So, if we enter a trade, we should place a sell stop order below this key level. Set the stop loss above here, and we sell below. This is much safer. The bullish trend continues. So we close this trade. The price has retraced to the key level. For a retest, a reversal candlestick pattern appears. Let's review a bit. On the 4-hour and 1-hour time frames, there's strong bearish momentum. Very strong bearish momentum. The pullback has ended. The price has retraced to this significant key level for a retest. Theoretically, if the bearish trend continues, there's no reason for the price to break above this significant key level. Plus, the distance between this key level of the minor wave and this significant key level is far enough apart to manage a trade. It's a sufficient distance for trade management. In this case, we'll enter a sell trade. In this scenario, the price retraces to the key level of the minor wave. Achieving a risk-to-reward ratio of 1 to 2 is very good. We can manage this trade, so we've identified the entry point and a safe stop-loss placement. Where do we set the target? Typically, we set the target here, at the previous low. This gives a risk-to-reward ratio of 1 to 4. But as I analyzed, the trend on the 4-hour and 1-hour time frames has very strong bearish momentum. With such strong bearish momentum, it's highly likely the price will continue downward and break below this key level. So, let's zoom out to the bigger picture, which is the 4-hour time frame. On the 4-hour time frame, I'll draw 2 lines at this key level and here. What do you think when you look at this? The price has formed highs that are progressively lower over time, indicating increasing selling pressure. The selling pressure is getting stronger over time. This is a significant key level that the price hasn't broken for a long time, as we targeted earlier. Down to here, meaning the price will reach this level. If the price reaches here, it means it has broken below this key level. Once it breaks this key level, the next target will be this price zone. So, if we're going to aim big, we'll target all the way down to this price zone with a risk-to-reward ratio of 120. When entering this trade, we can't know for sure if the price will hit our target. But we have one final weapon: learning to trail the stop loss intelligently. That's our last tool. We learn to trail the stop loss smartly. When the price hits the key level of the minor wave, we trail the stop loss to our entry point. The price breaks the low, so we trail the stop loss down here. Some traders might trail the stop loss here. Should we trail the stop loss here? To me, it's not very clear, because this green candle spiked up and the next 2 candles are almost stagnant. It's not clear, it's not a swing high. I want to see a pullback like this, or at least a pullback like this, with a few candles spiking up. To confirm this is a swing high, here's a small tip for you. To confirm whether this is a swing high, we switch to a higher time frame, which is the 30-minute time frame. Looking at this, It's not clear at all. So, we won't trail the stop loss down here. We'll keep it up here. Why? Suppose we trail the stop loss down here and measure Fibonacci to here. Now, suppose the price retraces to this zone for a retest back to the Fibonacci. At the 0.5 to 0.618 levels, we definitely hit the stop loss in this case, plus the price has now broken below this low. Once it breaks this low, it confirms the bearish wave is still ongoing and will continue downward. So, we have no reason to fear trailing the stop loss down here. The bearish trend is still intact, so confidently keep the stop loss up here. The bearish trend continues. Be confident and keep the stop loss here. The price breaks another low, so we trail the stop loss here. The price breaks another low, so we trail the stop loss here. Here, there's a price zone where the price failed to break through twice. Pay attention to this price zone, but we don't rush to trail the stop loss here. Let's keep it here for now. Now, a double top pattern has appeared in this case. If you don't see the double top pattern, I'll switch to a lower time frame to make it clearer. This is the double top pattern. A double top in a bearish trend confirms that the bearish trend is still ongoing. Based on my experience, when a double top appears in a bearish trend, typically, the price will break below this zone and continue downward. But if the price doesn't break below, even after forming a double top and fails to break this zone, there's a 90% chance the trend will reverse. That's my experience. If you watched the video before this one, you'd understand this concept. So now, let's confidently trail the stop loss down here. And we've hit the stop loss. The trend reversed to bullish. So, this trade didn't reach the 120 risk to reward target. It only reached here. And that's how we achieved a 110 risk to reward ratio. Getting a trade with a 1 to 2 or 1 to 3 risk to reward ratio, with my analysis method, is not difficult. But achieving a trade with a 1 to 4 or 1 to 5 risk to reward ratio, and in this case, 110, is truly not easy. Let's not talk about market factors, but focus on psychology. Holding on to profits is hard. Harder than holding on to losses. But do you know? If you want what others have, you must endure the feelings others have endured. So, trust your analysis. Use smaller position sizes and try holding profits by trailing the stop loss wisely. You'll be surprised and proud of yourself. While some people complain it's hard, and others don't believe, some take action and practice. I'm not saying practice will make you an expert right away, but I guarantee you'll get better. And when you get better, the money will follow. Thank you for watching my video. See you in the next video.